In this video, we're going to talk about whether past mutual fund performance is related to future mutual fund performance. But first, why should we care? We should care because 1 in 2 US households has their wealth invested in mutual funds. In total, Americans have $24 trillion invested in mutual funds. And 89% of Americans say past performance is important. If it's not important, or if we're getting this wrong, then $24 trillion are being invested suboptimally. That's a lot of money at stake. We shouldn't get this wrong. How are we going to answer this question? We're going to turn to the research. Just for some background, a good finance paper gets 100 citations, and a good finance professor in a career gets 5,000 citations. That's a career. The paper we're going to look at today has 20,000 citations. So this is like 20 good papers all in one. This would make 4 careers. This is a huge paper. This way in the right tail of the distribution. Very few other papers get this many citations. So it's by Mark Carhart. It's called On Persistence in Mutual Fund Performance, and it's in the most famous finance journal in the world, the Journal of Finance. And if you want to read it, I'll put the information in the description below. You can find it online, but it's not going to be an easy read unless you're a finance professor. But today, I'm going to boil down what you need to know. I'm going to tell you what matters from this paper. What do we learn from this paper? So what does the paper do? It ranks mutual funds based on this year's performance into 10 groups or deciles, where the top or first decile has the 10% of best performing funds this year. And the 10th decile has the bottom 10% of performing funds. So the worst performing funds will be in the 10th decile. And then it looks at how those deciles do in the future. It looks over 5 years. For the next 5 years, does the first decile outperform the second decile and the third decile? Or do they all just go to the middle? So here's the main result from the paper. Along the horizontal axis, we have time. At the left, we have formation year. That's this year when he lumps the mutual funds together in the deciles based on this year's performance. And then going to the right, we see the next 5 years of performance. On the vertical axis, we have performance as measured by average monthly excess returns, what mutual fund investors care about. So in the formation year, at the very top, we have decile 1. That's the 10% of best performing funds. And we have 2 through 9 there moving down. And at the bottom, we have decile 10. Those are the worst 10% of performing mutual funds. And we care about whether there's persistence in mutual fund performance. So do the top performing funds keep outperforming the other funds? Or do they all go to the middle and perform the same after this year? And you can see that there's a big grouping in the middle. Decile 1 jumps right down to the middle in the next year, in the first year, year +1. And then it seems everything is just lumped together in the middle. There's no persistent outperformance. The only thing that is persistent or slightly persistent is the underperformance of decile 10. It takes it 3 or 4 years to get to the group. So you don't want to be in decile 10. To quote from the paper, Carhart says, "It is clear that performance persistence is gone after 1 year, except for the persistent underperformance by the worst funds." Another thing Carhart does is he looks at mutual fund expenses and how they affect performance. And not surprisingly, there's a 1-for-1 relationship between expenses and mutual fund performance, which means that if a mutual fund has 1% fees, return is lower by almost exactly 1%. This is not surprising at all. He also looks at load funds. A load is where a fund imposes a cost. If you give the mutual fund company $100 and there's a 1% load, that means they keep $1 off the top and they invest your 99. If there's a 1% load on a fund, performance is lower by about 0.8%. So it's not 1-for-1 like expenses, but it's very near. This makes perfect sense as well. So fees are bad, expenses are bad, load funds are bad. So when buying mutual funds, according to Carhart, you should minimize your fees because fees have a 1-for-1 effect on performance or on return. So Carhart's main test, where we rank the funds based on this year's performance and look at them in the future, is great. I mean, it seems totally intuitive, right? If these funds are able to persistently outperform, we're just going to see a straight line across the top, right? They're just going to be above everyone else forever. But that's not what we see at all. Everyone just goes straight to the middle. There's no persistence in performance. If this is true, should past performance matter at all when you purchase a mutual fund? No, we should care less about past performance. So here is a screenshot of Fidelity's mutual funds. This is what they show you. We can see all the mutual funds here in blue, and then the information they give you, that's the category. So these funds all invest in large growth firms, and we can see the year-to-date performance and the 1-year performance and the 3-year performance and the 5-year performance and the 10-year performance and then the annual performance over the life of the fund. And all this real estate here in the middle, this is all past performance. And Carhart's paper shows that doesn't matter at all. We should forget about that. All we should care about is this expense ratio over here that gets very little real estate. This is the most important thing when it comes to purchasing a mutual fund, and it's a good predictor of the performance, right? If Carhart says expenses have a 1-for-1 effect on performance, then we should care a lot about expenses, but we shouldn't care anything about past performance. So it seems a lot of Americans probably are getting things wrong. Contrary to what Americans think, past performance doesn't matter. Expense ratios are the only thing that matters. The average American family that's invested into mutual funds has $400,000 invested in mutual funds. So if they're buying based on past performance when they shouldn't be, and that's costing them 1% a year, maybe it's costing a lot more, but let's just say it's costing them 1% a year, 1% of 400,000 is 4,000, and that's going to compound to be 70,000 over a decade, and more than that over the course of their life before they retire. So if we're getting it wrong, this is a big cost, and we shouldn't be getting it wrong. We need to care about expense ratios and not past performance. The funds with low expenses are going to be called index funds, and I will talk about them more in another video, but we shouldn't be chasing performance when we buy our mutual funds. We should be minimizing our costs when we buy mutual funds. We want the Walmart of mutual funds. We don't want the Whole Foods of mutual funds. Thanks for watching the video. I'll see you guys in the next one. If you haven't subscribed, please click the subscribe button below. Thanks for watching. I hope you learned something. I'll see you next time.